Good evening, good evening, everybody. How y'all doing? How y'all doing? How y'all doing? Hopefully everybody doing well this evening. Hopefully everybody doing well this evening. If this is your first time tuning in to Tim's Tidbits, please allow me, with every humble bone in my body, to say welcome. If it's not your first time tuning in to Tim's Tidbits, I still want to say welcome. But I want to give you a nice hearty, well, thank you for always tuning in to Tim's Tidbits. If you don't know who I am, my name is Timothy Lee Rod Sr., aka Aranya Grande. That's just Big Spot if you don't hablo Espanol. And this is another episode of the Intraday Price Action Recap, as you see right over there. Now, this episode of Price Action Recap is being brought to you by the Smart Money Manuscript. Well, Tim, what is the Smart Money Manuscript? The Smart Money Manuscript is your step-by-step guide to actionable financial insights. Well, Tim, what does that mean? Well, that means that if you decide to purchase said course, if you will, inside said course, I'm going to share with you everything that I've ever discussed on this You of the Tubes channel from beginning to end. So if you want to be someone who just manage your own retirement portfolio, if you want to be someone who just know when to buy and sell stocks or ETFs, if you want to be someone who wants to trade options, day trade, swing trade, long-term swing trade options, if you want to trade futures, if you want to be a trader or investor, whatever you want to do, it's all going to be covered in the Smart Money Manuscript. Your one-stop shop for those that's in the gang, those who purchased the Discord membership prior to and still currently in the Discord and purchased it prior to May 27th, 2025, you'll have access to it for absolutely free. Everyone else, right? And you can get it for the low price of, hey, what's that on my screen? Get out of there. You can get it for the low price of $69.99. Tim, why $69.99? I don't freaking know. I wanted to be less than $100. And so I just picked a number. And they say when you put stuff on sale, you got to make it some weird number that doesn't end in a zero, which I don't understand. Right. So that's why it's $69.99. So it's being brought to you by the Smart Money Manuscript. Gang, if y'all want to pay $69.99 for it, I'm not going to block my blessing. I got people already reaching out to me, talking, hey, Tim, I'm going to buy it. Just support. Hey, Tim, I want to get it for family members. Hey, Tim, you're a great guy. You know, you do a lot of, yeah, okay. If you want to do it, I'm not blocking my blessing. But the reason why I say it comes to you all free, because it's everything that I've already talked about on here. And, you know, y'all have paid for the Asians thing, the boot camp thing, the Discord, hey. But hey, coming soon. Be on the lookout for the links. I haven't decided if I'm going to wait until I do the whole thing and then release the links, or if I will, because I've already start putting the educational material together, right? So I don't know if I'm going to wait until I get it all recorded and uploaded before putting the links out there, or if I'll start putting the links out there as I go along, right? It's a self-paced type thing. So, you know, a lot of times when you put out self-paced type stuff, people just rush through it and don't really get the full, you know, experience of it. So I don't know if I will start to put it out and do it kind of like drip content, where I release like a section at a time. I'll see. I'll see. How y'all doing today, man? Before we get started, as I always like to do, hey, I see light skinned Deborah up in here. What's going on, light skinned Deborah? Before we get started, as I like to do, I like to ask, did Price do anything today that caught you off guard? Did Price do anything that caught you off guard? All right. Shout out my dog Sherwin. Sherwin, I apologize. Sherwin, you know what I'm saying? You're a seasoned male like myself. And when I jump like that real quick, if you're watching on the TV, I probably caught you off guard and you probably grabbed the strap. You probably grabbed the strap and went to looking around. So I apologize, Sherwin, for, but that was just me asking if Price did anything that caught anybody off guard. So, what I'm saying? As seasoned men, whenever we see somebody just jump like that for no reason, we get the strap. We just go straight to the, ain't no questions. We ain't asking like, hey, what you running from? Nah, we just get the strap and we ask questions later. Right. So I jalapaz, sir. So now with that, did Price do anything that caught anybody off guard? When you know what I'm saying, when you would look, you be like, hey, why did it do that? If it did, right, feel free to unmute and say, hey, Tim, got a question. I was expecting this, and Price did that, right? Oh, let me put the link in the chat. Right there. Hey, come here. Why isn't it? Okay, there you go. Copy link. It wasn't popping up. I was clicking on the thing, but it wasn't popping up. All right. That's the link right there. I see we got Here to Learn and Share up in here. We got Kim up in here. We got Rhonda Green up in here. We got Jim up in here. We got Deborah. We got Yolanda up in here. We got Lump up in here. All right. See more numbers than I see names than that on YouTube, but them the only names that I see, so them the only names I'm gonna say. I don't see anybody, I don't hear anybody unmuting saying, hey, Tim, and I don't see anything in the chat, so we're going to get right to it. All right, we're going to get right to it. Oh, sorry about that, y'all. Yawning. All right, looking at the chart. Looking at the chart. Is there anybody that's present right now who was on the tape reading session this morning? If you were on the tape reading session this morning, either say me or put a 1 in the chat. If you was on a tape reading session this morning, I'm trying to don't you hate when you sit down and your tank top comes up out of your pants and then your shirt, the seat push your shirt up like this right here when you sit down, and so now your lower back is just touching the chair. It just, I don't know about females, because you know what I'm saying, I don't know if y'all be wearing tank tops, but I wear a tank top, and so it feels disgusting when my naked skin be touching the back of a chair when it's made out of like leather, any kind of like in my truck, like it's leather seats in my truck, and this right here is made out of some kind of fake leather. But I can't stand when my skin just touch this fake. And when I sit down, right, the my t-shirt get pushed up like this right here, because you know what I'm saying, when you get old, you flop, you just flop in the chair. When you get old, you don't sit down, you don't have no easy comfortable sit, you just kind of flop in the chair. And when you flop, you know what I'm saying, it push your shirt up in the back. But when it push your shirt up in the back, your tank top come out your shorts, it come untucked, and then now your skin just all in contact with the chair. I can't stand that. It drives me crazy. Now, whew, let me see. One, but could not really pay attention. So, here we go with the excuses already. I just said, well, you dare. And coming with the hard hitting excuses before I open my mouth. Cheese and rice. All right. So I see a few ones, right, for people who was there this morning, right? Now, for those that was there this morning, we see that the third, was it the third? Let me see. The dealing range, right? The time-based dealing range after 6, that was 1. The daily, low and high, that was 2. And then the 9:30 opening range, that was 3. Okay. So the 9:30 opening range. All right. So let's go to 9:30. Go to 30-minute charts. Let's find 9:30 in the morning. 9:30 in the morning. Boop. All right. 9:30. Buy side, opening range. This one low. 9:30 candle. Sell side. Sell side, opening range. This and below. All right. Then let's go ahead and mark out this one here. 6 o'clock here. That's 6 o'clock. Up to 9:30. $7.30. Now, okay, so remember this morning what we talked about, all right? And not just this morning, but we talk about it all the time, right? The importance of time and price, right? The importance of time and price. Today was wild in the market. Karen, speak on it. So, did price do something that caught you off guard? I don't know if you was here in the beginning when I always ask that. Did price do something that caught you off guard? You expected it to do something and just caught you off guard. If it did, let's discuss. There's a link pinned to the. I'm looking like this right here. If it did, let's discuss. That I be because I be looking at y'all comment, and so it be looking like I'm looking away from y'all. But let me look at the camera, right? I turn like this and look at the camera so it look like I'm talking to y'all. Let's discuss. If there's a link pinned to the top of the chat, right? Pull up, unmute, and say, "Hey, Tim, I was expecting Price to do this, and it just caught me off guard. It just, I don't know, it just came out of nowhere." All right, let's discuss. Pull up. Let's talk about it. So, the importance of time and price, right? If we look here, right, right, we for lack of better terms, right, call this a time-based dealing range, right? An algorithmic time-based dealing range, right? Because it's a dealing range based off of key algorithmic times, right? That's the buy side, that's the sell side, right? We call this a time-based dealing range, right? This is just something that I just call it because this is where I can make sense in my mind, right? Time-based dealing range, right? It's based off of key algorithmic times, right? It's the highest high, lowest low made during a specific algorithmic time window, right? This right here, that's a daily high, that's a daily low. This is a key algorithmic dealing range, right? It's a dealing range based off of a window of time that the algorithm understands, right? All right. And you can formulate trading ideas within these dealing ranges. Why is that? Because everything happens inside of a dealing range, right? And if Kashaya, you said very wild. Now y'all got my curiosity piqued. I now I want to know. I want to know now. Somebody, one of y'all, Kashaya, Karen, somebody pull up and let's talk about it. Because I'm like, hey, did Price do something to catch you off guard today? And ain't nobody saying anything. But then I'm looking in the chat and see, hey, the day was wild, very wild. So that means the Price did something to catch somebody off guard. So let's talk about it. Come on, pull up, share your thoughts. Come on. Please do so. I'm starting to want the participation to be active now because you're teasing me with these little bones of, oh, it was wild. Girl, it was wild. Oh, girl, look at my nails. It's wild, girl. It's wild. Come on, pull up. I can't get off it now. I'm stuck on the fact y'all said it was wild. It ain't nobody pulling up. So I'm gonna put a pin in whatever I was talking about. Put a pin in it, and we let's discuss the wild. Pull up on. Click on the link and pull up. Pull up on me. Pull up on me. Pull up on me. Trump announces Israel-Iran ceasefire timeline. He says what end the war. Live updates. Okay. Okay. Boy, my brother's a wild boy. I love you, a wild boy. I just see what you text. He must be keeping me. I just got here. My bad, Tim. But it went up and all the way back down, then up. That's the only thing that caught me off guard. Actually, when you put it like that, I'm just referring to the war. I guess I just wanted the market to fall because I have puts. I actually had all the liquidity marked, so nothing was unexpected. Okay. You said you wanted the market to fall because you had puts. Why did you buy puts? What made you buy puts? Just asking. Not saying you're wrong for buying puts, but what made you buy puts? Because reading the comment of you saying, Karen, this would be a lot easier if you just clicked on the Zoom link above and unmuted and talked. This would be a lot easier. But just reading the comment of you saying, I guess I just want the market to fall because I have puts, leads me to believe that you bought the puts. You have to download Zoom and you're lazy. Okay. Thank you for being honest. Thank you for being honest. Now I'm going to go back to what I was talking about. Take the pen out of that, and we're going to go back over here now. So these are algorithmic. They're based off of specific times that, oh yeah, everything. I was saying, why is that possible? Because everything happens inside of dealing ranges, right? The algorithm is always working inside of a dealing range, right? And you get a dealing range when you set new pools of liquidity by taking out like prior sell side and prior buy side. You're establishing new liquidity pools, right? That gives you a dealing range. But the algorithm works off of time first, so you can establish dealing ranges based off of the highest high and lowest low within specific algorithmic times, right? Because when you take out a low, right, and create a new liquidity pool to the downside, right, you're making a low. When you take out a high and make a new liquidity pool to the upside, you're taking out a high, you're making a high. So you're making the highest high and the lowest low, right, after taking out liquidity. So in a window of time, the highest high and lowest low that you make, that's a dealing range based off of an algorithmic time. That's why I like to call them algorithmic dealing ranges, right? That ain't nothing fancy new. That ain't nothing, no real name that Michael made, no name that Michael made up. That's just how I make it make sense in my head. And since it's based off of time, right? The algorithm knows that time window because it operates off of time first. So it know the highest high and lowest low it made during this algorithmic time window, right? So it knows that dealing range, right? And you can formulate your whole trading model around understanding this is my dealing range that I'm operating in. This is how I'm going to trade within this dealing range. Okay. How do we at the gang like to trade it? Right. We like to let it establish a dealing range, right? Let it engage with one side of the liquidity and then give you a signature if it wants to engage the opposite side or keep going, right? That's how we like to use the dealing ranges, right? And today, right, all three dealing ranges that we were looking at, we see that all three dealing ranges delivered, as Michael says, like gangbusters, right? When we and the 6 to 9:30 range, it gave you, and after looking at the end of the day here, it gave you an opportunity going long, short, and long, right? During the morning, it gave an opportunity for the short, right, that we talked about. And then it gave an opportunity for going long also, right? Same thing with the 9:30. The 9:30, it gave the opportunity going long and short. Gave the same thing, right? And then the daily, right? The daily dealing range that we was talking about. Remember what we said? We said we took that sell side, and when we came in this morning, we said we're looking for signatures that price is going to give you an opportunity to engage the opposite side. And there's our one, our two, and then our three, our third dealing range that we talked about this morning. All three of them delivered, as Michael likes to say, like gangbusters, right? Right? The daily dealing range, right? Interacted with the sell side, right? Gave us, based off of today's range here, a break in market structure, right? Based off of the overall range, a break in market structure, right? And then we did all of this and we came back there, right? You say, Tim, look at this crazy drop right here, right? Yeah, I see it. I see that crazy drop, but guess what that crazy drop did? You know what this is right here? That right there is midnight, right? That right there is midnight. You know what that is right there? That right there is the swing low, right? That's the lowest low that was created, right? And this moved down here, and then this moved back up here. That was the lowest low that was created during a New York session, right? During the New York session, right? That low right there, right? Right during New York. You don't believe me? Y'all don't believe me? Watch this right here. Watch what happened when I turn this to regular trading hours. You know what, Tim? What, Tim? Use a bad motor scooter. Right there, see? Right there. You see that right there? That low right there. We came down, set a low, traded up, came down, took out that low during the New York session. And then we rallied back up.
Hey, Tim.
Yeah.
With that being said, like we normally go to regular trading hours to see gaps. I think what you just explained is a good practice also to see that lowest low and highest high for possible targets. Do you recommend doing that when you kind of setting your charts up in the morning as well?
Where's C-Walk at? C-Walk.
Wait, did I miss it? My bad.
Nah, C-Walk, you in here, C-Walk? Yes, C-Walk in here. C-Walk, I think that's C-Walk. I think
I'm here.
C-Walk, is that you that always be pointing out them regular trading hour gaps when we be reading the price section? Do that be you?
That's me. I do the 15-minute. That don't work like a champ.
Yeah. So So it's a good thing. It's a good thing to always refer back to. And I just said that because C-Walk, he already in the practice of looking at regular trading hour stuff because we are trading the US indexes, right? So all of that overnight price action, that's that stuff that's happening during the Globex time. And the New York market hasn't had the opportunity to partake in that juicy liquidity, or it hasn't had the opportunity to reprice those imbalances. So if the market is being like withheld, or if it's feel over there pushing the button, right? It's a good thing to refer back to. Excuse me. It's a good thing to refer back to those regular trading hour PD arrays, because if the market is being held within a range, then the algorithm is going to be trading near these old PD arrays and these old lows that we have forgotten about because we're not Ant-Man. We can't look back through the candles and see it like Ant-Man can. That's why we got to train ourselves to be able to look back through them candles. And if we can't look back through the candles, we got a handy dandy little tool where we just flip it to regular trading hours. So it's always a good idea to know, right? Where am I in the sense of the New York trading hours, right? Where am I in the sense of, because that's our prior session. Just like we're looking at where am I in sense of the London, where am I in sense of the Asian, where am I in sense of the prior New York trading session? Because I'm going from session to session. Just like you go from macro to macro, you got a lot of candles in between there. And you'd be like, am I trading near the levels of that last macro? If I am, I'm referring to that high. I'm referring to that fair value gap. I'm referring to that breaker because it's the next macro, right? Or it's what's got previous, and it's another one in the future. I don't know what that word to be, but it's always good to know where you are in the sense of the last one, right? The last session, the last New York session, the last New York PM session, the last New York AM session. So if you're in a New York AM session and you're trading near a New York AM session levels, where am I in reference to that? If I'm in a New York AM session and I'm trading near a New York PM session, where am I in reference to that? So you look for the exact next, and then you go to the next that's, you know what I'm saying, like kissing cousins, like New York AM, New York AM, New York AM, New York PM, right? New York PM, New York PM. New York PM, New York AM, right? Where am I in sense of the next, right? All right, hope that makes sense to everybody. So when you put it on regular trading hours, it's a little more clear, right? It's a little more clear when you put it to regular trading hours, right? We came down here, made a low, traded back up there, right? Then we dropped down and gave the New York morning set, the New York afternoon session, really, but the New York session, the opportunity to take out this sell side. And then we went back up to that high, all right? Because this is the daily low there. We took that daily low during the gap down. We gap down like way down here somewhere, taking out the daily low, wick down, right? And then we had wick down here somewhere crazy, and then start to trade up overnight. And then during the New York session, we came down and took out that sell side and then went up. Okay. Now back to electronic trading hours, right? That's that low right there, right? We want to become Ant-Man, right? Where is he? Where is he?
Tim?
Yes.
Hey, it's Corinne. I downloaded the Zoom.
Oh, how you doing?
I thought that was pretty ignorant, so I went and said, let me download the Zoom.
How you doing?
I'm doing good. How about you?
So what made you buy the puts? You said I wanted it to go down because I have puts. When I hear something like that, that makes me think that you said, hey, we've been going up. We got to come down. Let me buy some puts.
Right. So I actually bought this put back in May, and it expires on August 29th. So I'm just
Bought a put on what?
Bought a put on the SPY, which, same as the NASDAQ pretty much.
Yes.
So
yes. Same as
yes. Okay.
Yeah.
Very similar though. So yeah, so I bought it, and I've been seeing that price is trading in a range, and I just thought with the war, it should drop, but it did drop. It did drop in the futures, but then it made a comeback. So it definitely tells you that it's algorithmic.
When'd you buy it? You said back in May. Back in May what?
May 12th.
May 12th. Okay, so here we are, May 12th.
And I bought a 550 put.
Okay, so May 12th. Let me get over here to Spylean. Let's go to Spylean, y'all. I want to get the Spylean. I can looking at the futures helps me with like seeing all the price, but let's go over here to Spylean. Spylean, where you at, baby? Yeah, SPY. Ain't been on the SPY in a minute. So May 12th, this day right here. Ooh. Ooh.
Mm-hmm.
Ooh, what?
Mm-hmm.
Now, I ask you again, what? Looking at the chart.
What was I thinking?
What made you say, let me buy a put here? What now? You know what I'm saying? Because I can look at this. And see a reason from a turtle soup aspect. But just looking at this chart, right? I'm going to do this right here so people can't be fooled by hindsight bias. Looking at the chart like this right here, that's May 12th I have circled. What about this outside of a turtle soup aspect of entering above a high right here, using it as a turtle soup, right? And if you use it for a turtle soup, you wouldn't still be in it now, because if you're buying with a turtle soup, you have a very tight, rigid stop, and you're minimizing your loss, right? You would be using a high very close to price, either there or there, right? If you're buying on a turtle soup, your stop is more likely going to be here, because you're keeping a very rigid stop based off of how this price is set up here. Because when you're buying you're buying puts on a turtle soup, that'll be a turtle soup sell, right? When you come above this high, you're entering and you're keeping your stop very tight because it's like you're fading a breakout, right? And if the breakout runs on you, right, you're looking to get out very quick. Right now, outside of a turtle soup sale, what at this point made you say I'm buying puts right now, besides the fact that we was just going up and you feel like it got to come down?
Political events, our president. I think I forget that the market doesn't have feelings. And I'm basing it really on feelings and assumptions and not on, looking at the chart. But
Now,
I knew
feeling,
that price eventually is going to come down, and I saw that gap there. So, but that doesn't mean there's always going to fill the gap as we see.
yes, you're right.
But yeah, I'm just was thinking emotionally. I'm too emotional when it comes to the market,
We
and I'm
all
like,
are.
you know,
We all are. Now, okay, now let's look at this. We have that's the 12th. That's the day you bought it, right? That's the day you
hmm
bought it on the 12th, right? So now let's look at I'm going to mark this right here. This is the day that the market opened on the 12th, right? Uh that's where it opened. I just want to mark that so that I can when I move around I can visually see what's going on. So now let's pop up to a weekly chart, right? Oh, that week did you dirty. It kept going up. It kept
hmm
oh, that was a Monday. That was a Monday. Oh yeah. You should have been got out of this. But that's neither here nor there. Right.
yeah, because I'm in it.
Yeah, you
So,
should have been got out of this, but that's neither here nor there. Now, so looking at a weekly chart here, right? Right. You always want to have a reason to buy. And the reason you want to buy is because you understand that price moves from liquidity to imbalance, liquidity to imbalance, liquidity to imbalance. That's how the market moves. Liquidity, imbalance, liquidity, imbalance, liquidity, you know what I'm saying? Or however you want to say, if you want to say imbalance, liquidity, imbalance, but it's always seeking liquidity and it's always seeking balance, right? So if the market, right, and right here, if the market is in a buy program, right? If the market is in a buy program and um we if it's in a buy program and we haven't um reached liquidity and given us a reversal signal, we don't want to try to pick the top or the bottom. If it's in a sell program and it hasn't reached sell side, right, and giving you a reversal signal, you don't want to try to pick the bottom. If it's in a buy program and it hasn't reached buy side and giving you a reversal signal, you don't want to try to pick the top, right? So looking at the weekly chart right here, right, when price got here on Friday, right? So on that Monday, when we gapped up here, right, there is nothing algorithmic signaling that we don't want this high because we're in a buy program and this is the high that we're looking for price to go to, right? All the way from way down here, we're looking for price to come here, right? And then taking out this high right here, when we gapped open, taking out that high, right? That's just giving you a bullish breaking market structure on the weekly time frame here, right? Because price came here, dropped this high, came down and took out these lows, right? And now we've come back up and got a bullish breaking market structure, right? So before getting this bullish breaking market structure, right, it's like we respect this down close candle, right? It's showing you that's in the buy program, right? We set a down close candle, right? And then we close above it, right? And then we come here, respect the down close candle, and then close above a volume imbalance, right? It's respecting these discount PD arrays, right? We got a bearish volume imbalance. We got a bullish order block, right? A bearish candle. We're respecting. So it's showing you that it's in a buy program, right? So now we're in a buy program, and then we get a bullish break in market structure, and then you buy puts. You see what I'm saying? You're going against the buy program, right? The buy program, you're looking for it to reach the buy side liquidity, right? Why am I looking for it to reach buy side liquidity there, right? Because this liquidity here, right, that's not the beginning of the move, right? This is just giving you your bullish break in market structure. This is the beginning of the move, right? We came down, like smart money got short above the highs, came down, had a bearish break in market structure, retraced back up, gave an opportunity to participate, came down, took out the sell side, right? Now that it's coming back up, we got a bullish break in market structure, right? And you're trying to see, do we get an opportunity to participate and take out the buy side, right? And here, buying puts here is going against what the algorithm is showing you, right? Now, you said feeling and emotion, right? Feeling and emotion, you can add it to the sentiment of the market, but you have to add it to the sentiment of the market when it's in the vein of what the market is doing, right? So if you're looking at something that you anticipate to be like, if it's in a set, let's look at who follow oil. What is oil doing? Is oil going down right now? What is oil doing? What's oil? Somebody, what's the oil ticker? Who know the ticker for oil? What is oil doing right now?
CL.
Check out.
Say yeah, crude oil. Okay, so oil, right? Now we got oil. Oil right now, oil is in a sell program, right? Oil is in a sell program. So if we apply the same idea of we're in a war, whatever is high, blah blah blah, tensions, whatever, right? If we apply it to the fact that we're in a sell program and we say, okay, right, they may use this news to push us to this sell side liquidity right here, right? Because we're in a sell program, we got equal lows there, and so they may use this to push us there. Then you can think about like stuff like, okay, geopolitical is oh, that's Colgate. What's oil? That's Colgate.
It's CL1, and then yeah, CL1. That's what I put in.
Oh, it's that crude. Yeah, I thought I saw. Okay, boom. Right. Okay. So again, right, when a sell program here, we're consolidating, right? And then you say, okay, they can use this to push us back down to this area right here, right? Because right now it's in a sale program. We're hanging out, not doing nothing. Okay, they can use it to push us lower. They can use this news to push us lower. Or if oil is showing you strength, like you can say, okay, we're in a buy program, right? We haven't reached the high, right? How we've reached this high. But if we was in a buy program and we haven't reached this high, then you can say, okay, it's going to push us to that high, right? It'll push us to that high because, you know what I'm saying, the price of oil may go up, because if this happens, then they're going to be worried about we don't have enough reserve on hand. And since we don't have enough reserve, the price of oil going to shoot up. You can use stuff like that to add it to, are we in a buy program or a sell program, right? You can use that stuff, but you want to see where we are before you make that decision, right? Are we in, right? Are we in a buy program, right? We see we was in a buy pro, and then we look at the daily chart, right? Looking at the daily chart here, right? We can see here when we closed this day, right? We on the daily, we had traded above this high here, came back down, right? And then moved up, and then we were consolidating here. So now you see, right, we've come down, right? we got what appears to be a smart money reversal, right? Then we got, once we trade back up to there, right, that was our low risk buy. So now we know that we're on the right side of a market maker buy model. So we're not looking for price to come back down. We're looking for price to complete the market maker buy model. What is it complete? This is the smart money reversal. Where's the initial consolidation? Here, right? So we're looking for price to complete this market maker buy model, right? So here, right, we've had a break in market structure on the daily, and now we just got a break in market structure, right? This is starting a new week, right? So now this is a weekly level, because on the weekly chart over there, right, that's that high right there, right? So that's giving us a break in market structure on the weekly level, right? So now looking at where we are in price, now you're looking for reasons to why CIP, right? FOMC, WAR, you know what I'm saying? You know what I'm saying? President Trump, you know what I'm saying? Anything that the algorithm can use as shock value to send the market rocketing up, right? Because we're in a buy program and we're looking for anything that they can use to like rocket price at an expedited rate, to make it move fast, to finish this buy program, because we haven't completed the buy program. So we don't want to buck the trend. Like I say, if you're looking to try to trade it on a turtle soup because you think, oh, we've traded above this high, as far as it's going to go, and you can't really see the fact that you're in a market maker buy model, and this is the terminus for that market maker buy model, right? If you're trading on a turtle soup above that high, you want to keep your stock. Like in that case, you would have been out that same day, because it looked like we traded above that high that same day, right? Nope, we didn't. Right. So that day you probably still be in, but the next day, I'm pretty sure, yes, the next day you will be out of there, because you keep your stop very tight. Right. And then say you had a large stop and it's there. Right. But by that time, right, I wouldn't want to still be in the put, right? If we're running that far and I've gotten in a put, like if we're going up 2 days, like, you know what I'm saying? Like that day was an indecision day, right? And now we're not showing any signs of coming down, right? The indecision day, okay, it's indecision day, giving you some hope, but when we go up again the next day, right, you're just praying, you're hoping and praying at that point. All right, so, and I understand you bought time, right? I understand you bought time, but we want to buy the time
when it's right,
based off of algorithmic reasoning, right? Because when you buy the time just off of what I think, now you have capital tied up for no reason, with with the chance of maybe getting a loss, right? Will the market drop back and you can somehow get out of it? I don't know. I don't have a crystal ball, but I don't want to tie up my capital and hope and pray that it come back, because so many times we've done that in the past, because we got so used to 2020 and 2021 where we buy stuff and it just go up, or if we could just buy stuff and it'll drop for a week and then it'll just rally for 3 months. You know what I'm saying? We can buy something, it'll go all the way down to 10%. And then we'll end up getting 300% out of it, because it just rallied straight up for 2 months, right? But that ain't the conditions that we're in no more, right? We ain't in them conditions no more. So we got to be very strategic with our stops, and we got to be very disciplined with our stops, and we want to cut our losers quick, right? Cut our losers quick and let our winners run. Right. So looking at price, right? Looking at price, we're still well above where you even bought, right? this is the day you bought here, right? And this, I'm not sure how, you know what I'm saying, how the theta had eaten away at your position on this pop up here, but I'm not sure if this day right here would have brought you back to the green to be able to get out. But
What day was that?
That's the 23rd, right?
Oh, I could have got out on the 29th or the 30th. I think I could have gotten out almost even.
So right around here, you was, so this drop here brought you back into favor because it moved fast.
Yeah, on
And
May
then
30th, I was basically almost even.
so here when it dropped back there, it was bringing you back to almost even. So,
Mm-hmm.
but looking at the chart, right? And this is just for future reference, right? Do you understand? Do you understand how market maker models work?
Yes.
You do understand how they work? Okay. All right. So if you understand how they work, then looking at it here, like if we come here, right? Because we don't want people being misled by the benefit of hindsight, right? So we're on the right side of a market maker buy model, right? Smart money reversal, low risk buy, right? This right here is our first stage of accumulation there, right? So when we move into this second stage of reaccumulation there, we consolidate, we expand, we retrace. What do we expect next?
Consolidate.
Nope.
Oh, you said retrace?
Yes, we consolidate, we expand, we retrace. So what do we expect next?
I don't know.
All right. So because if the delivers prices in two different ways, right? The first way and the way that we like to see is it consolidates, it expands, it reverses, it retraces,
Oh,
and then it
okay.
delivers, right? And then the other way it does it is it consolidates, it expands, it retraces, and then what does it do?
Reverses.
No, this over here. Consolidate,
Oh,
expand,
I don't
It
really.
reverse,
delivers
retrace.
now. It
Yeah,
delivers now.
now it delivers.
Oh, okay.
So you consolidate, expand, retrace, and then deliver. Right.
Mm-hmm.
So when we came here, right, this was a buying opportunity. Remember what I said? Remember what I said when we first, right? When I had everything cut off, when I had everything cut off back to here, right? I said we're on with a market maker buy model. We have expanded and we're looking for opportunity to retrace to participate going long.
And that was the discount right there.
All right. And when it came that when we expanded up, when we because we gapped up, right? We expanded up, then we retraced down, right? That retracement was our opportunity to look
Right.
for a chance to buy, right?
Mm-hmm.
Based off the market maker buy model. That's why I say that day when it came back, right? When it came back that day, right? This was your opportunity to cut sling load because this was your opportunity to say, hey, I'm on the wrong side of the trade here, right? I'm like, because once you know you're in a market maker buy model, right? And you see a gap up, right? You see a gap up here, and then when we come up and we trade back down, right? When we open this day, we gap down into this gap and we never tried to fill it. We opened and went up, right? This was your opportunity to cut sling load right here because you're in profit, right? It's the retracement to help. And then you see here, right? We consolidated, expand, retraced, and down now we've gone up and we've delivered above the high, right? Because when like the high that you make on the when you're making the retracement, what do we look for as a target? We look to the left to the next high, above, high or low, above or below the retracement swing, right? So there you go. Consolidate, expand, retrace, deliver. We deliver there, right? And now you're looking for an opportunity to complete the market maker buy model, because now we're all the way at the top, right? So now we're looking for some kind of low resistance liquidity run to go take out that right there. All right. So it's okay to like take like a short-term thing where you're looking for a retracement, but if you are in a buy program, you don't ever buy long-term puts. If you're in a buy program, if you're in a sell program, don't never buy long-term calls, right? You buy the longer term, you buy the long-term things. When I say long terms, I'm talking about like 2 months, 3 months, 6 months. You know what I'm saying? Like for me, I'm not buying puts out more than 3 months. I'm not buying no leap puts. I ain't, because the market is predisposed to going up. But if you're in a buy program, don't ever buy long-term puts because you're fading what the market is doing. If you're in a sell program, don't buy long-term calls, right? If the market is in a clear sell program, you see that is showing you I'm in a sell program. So you wouldn't buy calls over here. Why? You're on the right side of a market maker sell model, right? So when you're on the right side of a market maker buy model, don't buy long-term puts. Okay, this is just future reference. Now, again, can the market just drop and give you an opportunity? The market can do whatever it want to do, but me personally, I don't want to tie up my capital all this time, right? So right now, from there to where we are today, right? That's 42 calendar days, 28 trading days that your money has been tied up in some puts. And right now, I'm pretty sure you're down, right? Because we're well above where price was when you bought, right?
Right.
So now your money is tied up and you're down. So it's like, you want to be strategic about how you utilize your capital. You don't want to put your capital in there and just got it like on the sideline, and now you're hoping and praying that it will come back and let you get out when you're on the wrong side of the market maker model right now.
Right. That makes perfect sense. Thank you for clarifying that for me. Maybe I can save a few dollars moving forward.
Yeah. So just and just like I say, like, will it come back? I don't know. I
Have to
don't
get
have a
those
crystal
other
ball.
those ones.
Say again. Oh, that's just you learned off mute again. Yeah. So yeah, but just always remember, where are we in price, right? Are we in a market maker buy model? Are we in a market maker sell model? If we are in a market maker buy model, are we in a dealing range that's offering me a discount, right? If we're in a market maker sell model, are we in a dealing range that's offering me a premium, right? You want to know, where are we in price before you pull the trigger. Okay.
Mm-hmm.
All right. And like I say, yeah, right now, it ain't looking too good. It ain't looking too good, but hey, you know what I'm saying? You can put into effect. You say you got into when?
I have until August 29th.
August 29th.
Mm-hmm.
You can maybe look at figuring out some kind of way to get a hedge. You could, you know what I'm saying? You could say, hey, I'm a cut my losses, and if it offer me something else, I may try to enter. But you know what I'm saying?
Yeah.
It's just up to you. Like, maybe, you know what I'm saying, you might say, hey, let me figure out a way, if the market gives me some type of opportunity to get like a nice hedge. If we sell off one day. You know what I'm saying?
Right.
If we sell off one day and come to a discount that sets up something that offers you a opportunity to buy some shorter term calls.
No, I
Right.
think I'm going to get out. I do pretty good with day trading.
Mm-hmm.
So I think I'm just going to get out and use that money. I think it's like $600 left, and just try to day trade that and make something happen.
Yeah, because here we came up and touched that SIBI right there. We came up and touched that SIBI. Respect consequent encroachment of it. Then we came it down. We're right there on top of this inversion fair. I mean, this, I said invert, but on top of this fair value gap right here, right? And on top of that busy right there, still respecting consequent encroachment of that. So we're like in between the tail of two cities right now. We're right in between a bullish and bearish PD rate. Respect consequent encroachment there, respect and consequent encroachment there, right? We also traded down into a breaker, all right? Now, we did come down. We did come down and create some relative equal lows there. All right.
Can I ask you a question?
Yes.
When trading the futures, the NASDAQ, and if I wanted to trade because I use Ninja Trader, what would you say for yourself would be a comfortable dollar amount to, with your stop losses, with everything? What would be a comfortable dollar amount you think to have?
Oh, well, I can't answer that for you. It just depends on your capital. Um, it depends on the capital, like how much money you're starting with, and how a easy hip pocket way to a easy hip pocket way to figure out how much I can risk on any trade is to ask yourself a couple questions, right? Right. Just give me a number that if you was to put some money into your Ninja Trader right now today to start trading with, how much money can you comfortably put in there without missing it, without taking away from your family, without saying, oh, I need to go get some money out of there? How much can you put in there right now? Just a reasonable number that you can put in there and say, okay, I'm gonna try to trade a Ninja Trader with this right here.
I say 2,500.
Okay, so $2,500. All right.
Mm-hmm.
So $2,500. Now you say, okay, I got $2,500, right? So with this $2,500, right, I'm gonna trade, over the next 3 months with this 20. I'm just throwing some numbers out here. You just want to give yourself a time window. I'm trading over the next 3 months with this $2,500, right? And I'm giving myself, um, I'm giving myself 50 trades. I'm going, like, I'm giving myself 50 trades before I just blow this $2,500 over 3 months, right? So you give yourself 50 trades, and then you say, okay, so 2,500 divided by 50, right? That means you can only risk up to $50 per trade, right? Because you say, okay, I got $2,500 and I'm giving myself 50 trades. And it's because if I have 50 losing trades in a row, I don't need to be trading. You know what I'm saying? So that, and then you say, okay, I can risk $50, right? So with risking $50 per trade, right, with $2,500, right, you should not be trading any minis. You shouldn't be trading an ES mini or a NASDAQ mini. Why is that? Because an ES mini is $50 per point. So that means if you put on one contract, right, you could put on a contract with $2,500 because it only costs, you only got to have $500 of capital to put on a ES mini contract, but it's going to be $50 per point, right? So that means your stop loss can only be 1 point, right? You don't want a 1 point stop loss. On the NQ mini, it's $20 per point. That means your stop loss can only be 2.5 points. You don't want a 2.5 point stop loss on the NQ mini. So this tells you right here, with $2,500, if I'm giving myself 50 trades to blow this account, I can either trade the ES micros or the NQ micros, right? And with the ES, right, we're on the ES right here, right? So with the ES, right, if you get this little trade tool right here, position tool, all right, so I'm just gonna click it right there. I'm gonna go inside here, I'm gonna put $2,500 in there, right? And then I'm gonna change this to dollars, and we're gonna put $50 there, right? And then that tells you that $50 is 2% of your capital right there, right? Because so if I come in here and put it on percent and I say 5%, right? 5% is $125. And then if I put it on 2%, 2% is $50. So you're risking 2% per trade. Okay. So you can either put it on flat dollars or percentage. If you put it on percentage, it's going to take it, then you would have to update your account like every time, right? And so I got that set to $50, and then I'm on the ES. So you just have to bear that. Matter of fact, let me go to MES and do it so it makes sense. Because if you're looking at it here, right? If I come down here, I got it set for $50. And as I stretch this out, looking at the ES, right? If I pull it all the way to here, if you look at that number over there where it says quantity, right? It says 0.1, right? Because it's a tenth of the ES, and then I'll go to MES to show it. So that means I can only trade with my risk tolerance, right? With my risk tolerance, if you look right over here, right, it's telling me, come here. It's telling me that I can only trade 1 micro because it says 0.1 with a 10-point stop loss on the MES, right? Because this is the ES. So now let me go over to the MES. Right. Come over here to the MES, and then I'll do the same thing, get the tool, put it there, and put a 10-point stop loss here. Right. 10-point stop loss. See, quantity 1. It's saying I can trade 1 MES contract if I have up to a 10-point stop loss. Right. It's showing me what I can trade with the amount of money that I'm willing to risk. Right. So I can trade 1 MES contract there. Okay. And then if I was on the NQ, right, let's go to the MNQ. All right, go to MNQ, right? Come over to the MNQ, same thing set there, right? It's $50, right, on the 2500, right? And then now here it says that if I come here and have a 25-point stop loss, I could trade 1 MNQ contract. Right, I could trade 1 MNQ contract, 25-point stop loss. That's a very big stop loss, right? It's not unheard of, but I feel like you can get a better stop loss if you're trading properly on day trading, and you can get a better stop loss like anywhere from like 12 to 15 points would be like, you know what I'm saying, comfortable, right? That's like a comfortable stop loss. Above 20 points, right? I feel like you could get a better entry, right? You could get a better entry. If you're going above 20, you could get a better entry, in my opinion, right? Because sometimes I'll trade with like a 10-point stop loss on the NQ. You know what I'm saying? 10 points is a little bit tight. That's getting a really good entry, but anywhere between 12 and 15, you know what I'm saying, that's a little bit more comfortable of an entry, but it's letting you know, okay, this is how much I can trade. But that's going to be up to you, like how many trades are you giving yourself? What are you comfortable losing, right? So you say, I got $2,500, right? How many trades am I giving myself, you know what I'm saying, to trade over these 3 months? If I just go on a bad losing streak, this how much I'm willing to risk. And then you have to be honest with yourself, because people come out there and be like, okay, I got $2,500, I'm gonna risk $500 per trade. That's not comfortable.
Right.
That's over leveraging. You know what I'm saying? That's over leveraging. You risking way too much capital. You know what I'm saying? Because if you got $2,500 and you're risking $500, right? You're risking 20% of your account. You're only giving yourself 5 opportunities to be wrong, right? You're only giving yourself 5 trades to be wrong. And anybody can have a 5-trade losing streak, right? You're giving yourself 5 trades to be wrong, and your 2,500 is gone, right? So you want to give yourself as many trades as possible to be wrong, right? And then have a decent risk to reward, right? You want, like, if you're risking, if every time you trade you're risking $50, right? You don't want to be always making $40 or always making $60 or always making $50. You want to be making at least $100 or more. So when you lose, right, you're not totally wiping out everything you just did. Right. So so you don't want to start fiddling with your, like, if you take 2 losses, right? You risk 50, risk $50, take a loss, risk $50, take a loss, and then you risk $50, and then when you get up to 60, you just close the trade. You don't want to do that, right? Because if you constantly, like, just taking it quick when you're getting up, right, you're never going to be able to grow your capital because you're afraid that, oh, I'm gonna get stopped out again. You see what I'm saying? You want to let it play out, right? And then you want to say to yourself, okay, I'm going to take setups that's at least 2-to-1. All right. I'm gonna take setups that's at least, so if you say I'm gonna take setups that's at least 2-to-1, right? So we're just gonna come here and we don't have anything. We ain't got nothing setting up over there. So we'll just come right here. Right. We'll come here and we'll say, wanna get on there. And we'll just do the right there. So it'll just say 1. What am I? Oh, this ain't set right. I had it on 200. I'm like, wait a minute, what's going on there? Okay. All right, so we're gonna set it to the basic. What we was talking about, 2-to-1, go all the way down there. Okay, so, and then we'll come here and you say, okay, I'm going for at least 2-to-1 each time, right there, right? So now you're risking 50 here to get, you know what I'm saying, 100 here. Okay, so you're risking 50 there to get 100 there. And the way you can offset it is if you can get a safe entry that lets you, let's come here, quantity of 2. All right, so now quantity of 2, and then, right, we're just doing this right here for hindsight, and we're saying that we're going to pretend like this was an actual fair value gap here, right? Like, because the fair value gap is down there, but it's a volume imbalance there. So we're going to say you was entering on that volume imbalance right there. And then you got your stop, right? You got your stop below the fair value gap there. So now if you go right here to a 2-to-1, right, that high, back at the high, is a 2-to-1, right? So now you can safely, right, you can get a smaller entry, right? You got it where it can be sized where you can actually put on the extra size, right? Meaning you can double the contracts, right? But now, since you're only risking 12.5 points, right, you only need 25 points for a 2-to-1, right? So now you're not risking any more money. You're risking the same amount of money, but you're getting your 2-to-1 inside of a smaller move, right? Because you're using the structure to be able to form a better entry, and you don't need such a large move to get your 2-to-1, right? Because instead of risking 25 points, you're only risking 12.5. Right, so you can utilize like that, but you always want to make sure it's going to be a thing where you can actually put on the extra risk, because if you just say this was the required stop right there, right, for this trade, for a trade like this, you can't put on the extra risk because it says you can only put on 1.66 contracts, right? to risk that $50. And you can't put on 0.6 of a contract. You can only put on another contract. So you always want to make sure it's giving you the where you can actually put the contract on, the extra contract on, but still manage the risk properly. Right. So like I say, I can't say, this, because when people say, oh, this is a good amount, don't listen to people like that, because they blowing smoke. They don't know what you can tolerate financially. They don't know what you can tolerate mentally as far as losing in a day. They don't, you know what I'm saying? Everybody risk management ain't the same. Everybody risk tolerance ain't the same. So, you know what I'm saying? If you say you're going to start with 2,500, okay, boom, 2,500. This how much time I'm giving myself to trade it. I think if I trade this many times over this time period, that's way too much. And if I lose this much, I don't need to be trading. So you want to get like a number that's going to bring that risk way down. You know what I'm saying? You want to get a number that bring that risk way down. That's, I just threw 50 out there and I didn't even know how much it was going to be, but you want to bring it way down. And you see that $50 is 2% of your account. You're risking 2% of your account. And you know what I'm saying? Some people say 2% is a lot. Some people say 2% is a little bit. I say just whatever you're comfortable with trading. And when you have like smaller accounts, the fact is you have to risk a little more when you have smaller accounts, right? You have to risk a little more when you have smaller accounts because the nature of what you're doing, right? It's like this, it's a fixed rate that it costs or gain. It's a fixed rate. You can't change that. So since it's a fixed rate, the only thing you can do is save more money. Like if you want to be in the club of, oh, I don't want to risk no more than 0.5% of my account. Okay, save your money and get your account to the point where risking 0.5% gives you an opportunity to take realistic trades, right? Because what people fail to tell you is when they say, oh, only risk 0.5%, they're not telling you what's a realistic trade. You see what I'm saying? Because if you're risking 0.5% and 0.5% of, and all you got is $500, right? That's not going to be a realistic trade. 500 times 0.0. Oh look, what's that? 1, 2, 2, 5. Yeah, that'd be 0.5% there. 1, 2. Yes, I think. Yes. All right. So that's $2.50. I was right. So that's $2.50. 0.5% of 500 is $2.50. Right. So you know what I'm saying? So that's not a realistic thing, right? Because if you got $500, right, and you talk about risking 0.5%, right, 0.5%, right, $2.50. All right, $2.50, and I'm on the MNQ, right? I'm on the MNQ, and I can take one contract if I risk 1 point. I could take one contract if I risk 1 point on the MNQ, right? Ain't nowhere in the world I can take a 1 point stop loss on anything. You know what I'm saying? So it's all about what's your risk tolerance and how much capital you got and how much you're willing to risk. So think about all those things, right? If $2,500 is your number, think about, okay, I got $2,500, right? How many trades am I giving myself in this 2,500 before I totally blow it, right? Once you get that number, just divide 2,500 by that number, right? Once you divide 2,500 by that number, then that's going to give you the amount that you can risk per trade, right? And you want it to be a realistic number, because if you come out there and say, I give myself 10 trades, right? You got 2,500 divided by 10, right? That's $250 a trade, right? That ain't realistic in my opinion, because if you got $2,500, right, and if your first trade is a loss, right, that's gonna be a big pill to swallow, right? That's gonna be a big pill to swallow if your first trade is a loss, right? And so you always want to, because when that equity start dropping, right, we go into panic mode when that equity start dropping, right? Right now you got 2250. You know what I'm saying? You got 2250, and minus commissions, right? So it's a little less than 2250, like a few dollars less than 2250, right? And then if you panic and then you rush into something and you take another loss again, now you got 2000, right? Now you got 2000. You know what I'm saying? And mind you now, so if you and if you trading, if you're trying to go out there and trade minis, right, you can hit that 250 real fast. Right. If you trade minis, you can hit that 250 real fast. If you trade the ES mini, right, $250, that ain't nothing but 5 points. That ain't nothing but 5 points. 5 points, you out of there. 250 quick, right? With the NASDAQ, that ain't nothing but 12 points, I think. I think it's 12 points. See, 250 divided by 20, 12 and a half points. 12 and a half points. Boom. You can get hit quick. You can get hit quick with 12 and a half points, right? It'll add up quick. And then the thing you got to remember, right? If you're trading the minis, right? As your equity start dropping, right? When you trading the ES, remember you need at least 500. If you're trading the NQ, you need at least 1,000, right? So if you bring your equity down, right? Let's just say you're trading the NQ, right? You're trading the NQ and you're trying to be greedy and you're trying to get it back fast, right? So now your first trade was a loss and you got 2250, right? You get into another trade, it start going against you, right? So you move your stop loss and put on another contract, right? So you just say right, you get into a long trade, right? And all right, okay. All right, so we're on the NQ, right? And then you get into a long trade, right? And you set it up and it says you could take one contract there. Right, you can take one contract there. And then you get into the trade, right? Here, you try to go long there, right? You're trying to go long here, and now the trade going against you, right? We say the trade is going against you right now. We're in a trade right now, and it's going against you, right? And then it start going against you, and you say, oh man, it's going against me. So you move your stop loss below this low, right? You put it below this low, and you add on a contract. Now, right there, it says you're down 11 points right there, right? So, right, let's do the math on this right here. Right. So let's say you entered at 22,250. Right. So you entered at 22,250.5. Right. That's the entry point on this trade right here. Right. And then you entered another one when it was coming against you. Right. And so that coming against you price there, we're going to say right there, what is that price there? 22,241. Right. So we just go with 22,241. Right. Plus 22,241 even. Right. And then you divide that back too, because it's the two entry prices because you're doing one contract a piece, 2 entry prices, and then divided by 2, right? Because you got 2 contracts. So now your cost basis is 22,245.75, right? And then it got down. The low on this calendar right here is, God, jumping around driving me crazy. All right, so the low on that calendar right there is 237, 237 even, right? So minus 237 even, right? So that means it went against you 8.75 points for your total position, right? So 8.75 points times 40, because you got 2 contracts on, is $20 per point times 40, right? That's $350. Okay, that's $350. You're like, okay, that's not bad. I'm only down $350. But remember, when you started out, you only had 22, you had less than 2250 with the contract cost. So you had less than 2250, right? So we're just gonna leave it at 2250. So we're gonna go minus 350, right? That means your equity is now at 1900. Guess what just happened to you? Do you know what just happened? Do you know what just happened, Karen?
No, what happened?
You just got a margin call. They automatically close your position.
Oh, shoot.
Because you don't have enough equity in there, because you need $1,000 per contract to keep that position open. That's your intraday margin. It's $1,000, right? And now your equity curve has dropped below 2,000 and you got 2 contracts on. Close the position automatically.
Oh my goodness.
All right. That's all the stuff. That's why you don't want to over leverage, right? This is just all the stuff that you think about, right? What's up, Rose? Rose, if you don't click on that Zoom link and pop in here, unmute and say hey to me. All right. We done spent a lot of time on that, but I just feel like this is very important. This is the important part of trading. You got to understand risk management. You got to understand what's realistic. People don't talk about these realistic things, right? We want to talk about what's realistic. So, and it's a marathon, not a sprint, right? This is a marathon, not a sprint. $2,500 is a great place to start, right?
Thank you.
Because think about it. If you go and buy a 50K prop firm account, right, they're only giving you $2,000 to trade with. So you have more money in your account than Apex is giving you to trade with. Now, the thing that they do, they give you enough money to trade with up to 5 minis, right? So you're really going to blow it fast, right? Because they're only giving you 2,000. You can only lose 2,000. Right? So you only have $2,000. So $2,500 is a great place to start, but you just have to manage it properly, right? And micros make money. Trust me, especially on the NQ, the ES2, but the NQ is very volatile, so they have bigger ranges, right? Because think about it. On the NQ, right, with one contract, a 25-point move is $50, right? So if you can get a 25-point move, right, once a day, right? That's $50 a day, right? If you can get a 25-point move once a day, and you can get more than a 25-point move if you are day trading, and you're day trading, you know what I'm saying, based off of what the daily chart is giving you. If price is moving and you're day trading and you're watching your dealing ranges and you got, you know what I'm saying, you're getting entries based off of consolidation, expansion, reversal, retracement, delivery. If you can get in during that manipulation leg of that reversal, right, you can get 25 points easy. Right, you can get 25 points easy. It's just about being disciplined, watching the signatures, and trading properly, right? I trade micros all the time, right? And you know what I'm saying? I've pulled down like $300 trades trading micros with 2 micros. I've pulled down $250 trades trading 2 micros. You know what I'm saying? I've put down $125, $150 trades, trading one micro. You know what I'm saying? So micros make money. You can make money off of micros. It's just you have to gradually build it up, right? You have to gradually build it up. And then the way that Michael teaches it, he teaches based off of like $1,000, right? So if you start out with $2,000, $1,500 or $2,000, right? He say don't trade more than one micro, right? And then every time you make $1,000, add a micro, right? So if you know that, and that's just how you teach. Like you start out with $2,000, right? And you know what I'm saying? You trade and trade, trade. When you get to $3,000, then add a micro. Now you trade in two micros whenever you take a trade, right? Then when you make $1,000, when you get to $4,000, add a micro. Now you trade in three micros when you're taking your trade. That's just how he, you know what I'm saying? That's how he don't teach like risking a specific amount or nothing like that. He just say trade one micro, trade the setup that you see in front of you, and every time you gain $1,000, add a micro, right? So you're pretty much not doing it based off of how much am I willing to risk. You're doing it based off of, okay, I want to go short here, right? I want to go short there, and I'm risking to the high right there, and I'm trading down to that low right there, or I'm trading down to that low right there, right? That's your setup. Boom. You take it, you trade it, you're only trading with one micro, right? And then after you get to $1,000, after you make $1,000 in this same trade setup, now you're taking the same trade, but you trade in two micros, right? You trade in two micros now. And then after you make $1,000, it's the same setup, but you're putting it on with three micros, right? You just trading what's in front of you, but you're trading based off whatever your capital is. You only add a micro once you grow your account by $1,000. That's the way he was teaching his son, Caleb, right? So there's two different methods you can do it based off of the capital you got starting out with one micro, or based off of I'm gonna give myself these many trades and this is how much I'm gonna risk per trade, right? The way that he do it, you have an opportunity to trade more often because it's not restricted to a certain amount where you can put your stop loss. You can just trade what's in front of you, right? But at the same time, you got to make sure you're taking quality setups. Because if you're just trading it like, oh, I'm just going to trade one micro and I'm just going to jump in anyway. No, you want to make sure you're trading quality setups, right? And what I mean by quality setups, you want to make sure that you're looking to say, okay, we got a low, we got a high right there. We're inside of a bullish dealing range. We trade back down there and we've extended the range up, right? So we're still in the bullish dealing range. So when we trade back down to a discount of the range at this balanced price range, I'm looking to go long, right? So I'm looking to go long here, right? So boom, I'll come in. I'm looking to go long. I'm going to go long right there. And then I'm going to risk it down to there, right? Below the low of the bottom fair value gap, right? There's a fair value gap here, and I put my stop below that. Because if we come down to that fair value gap, that's fine. But if we trade down, I'm on the wrong side. So that's why you put in your stop there based off this price, right? And then we're just going to pretend like it's a high right here that we're shooting for, right? So boom, boom, you take the trade, end the trade, boom, trade was successful, right? Voila, everybody happy. You know what I'm saying? Based off of that right there, you just made almost $100, right? Just made almost 49 times two, right? You just made almost $100 and you risked like $23, right? You risked $23, 11.5 times two, right? $23, right? And 49.25, 98.50, right? So you made close to $100, right? off of that trade right there. And that's just based off the fact that, okay, I'm just taking one micro, this my entry, this my stop based off of price action. That's what I'm looking to get out. Right. That's quality setup based off what price doing, right? You're in a bullish dealing range, right? This is our last leg of the bullish dealing range there. We retrace back down to a discount. We extended the range up, right? All of this right here is a balanced price range. We trade back down into it. I'm getting long at the fair value gap, right? Risking to there, going to there, right? Looking for quality setups, not just, oh, I'm going to jump in anywhere. All right. Now, let's go back and look at price real quick. An hour and a half later. Y'all blame Karen for that. Okay.
Thanks again.
You're welcome. So we was looking at our algorithmic dealing ranges, right? And for those who are not privy to what I mean by algorithmic dealing ranges, right? Time runs off. Time is, I mean, the algorithm runs off of time and price. I'm sorry, y'all. The algorithm runs off of time, then price. And we all know that price is king. We all know that time is king. I said price king. Time is king. Okay. So you can formulate, right? You can formulate strategies, anything dealing with time, right? These are your sessions. Okay, you have sessions. Inside your sessions, you have kill zones. Inside the kill zones, you have macro windows. Inside the kill zones, you have opening ranges, right? Or inside the sessions, I'm sorry. Inside the sessions, you have opening ranges, right? So you can formulate dealing ranges around anything you want. You can formulate it around a day, right? Because that's a specific time that algorithm is referring to. You can form it around a session. That's a specific time. A kill zone, that's a time. A macro window, that's a time. That the opening range, that's a time that the algorithm is referring back to, right? So when we look at time, right, we got our daily high and our daily low. Okay, daily high, daily low, right? That's a algorithmic time, right? That's a dealing range. We're looking to trade inside, right? We have our New York kill zone starts at 7:30, right? So looking at the highest high from 6 to the lowest low from 6 up until 9:30, right? You can formulate a dealing range around that, right? Our highest high and lowest low, right? Before 9:30, right? Our pre-market, right? Highest high and lowest low before 9:30 in the pre-market. You can formulate a dealing range around that, right? From 9:30 until 10 o'clock, right? You can formulate a dealing range around that, right? Why is that? Because that's the opening range, right? We have pre-market that which falls inside of the kill zone, right? The kill zone for the New York AM is from 7:30 to 12. So inside that pre-market time from 6 to 9:30, you can get the highest high and lowest low from pre-market and use that as a dealing range, right? So opening range dealing range, pre-market dealing range, session dealing range, daily dealing range. You can formulate a trading idea around these times, okay? And this morning, as we looked at, we was on the NQ. Let's come to the N. Well, that's the ES. I'll just stay on the ES since I'm here on the ES, right? So we come here on the ES, and we know that that right there is the highest high, lowest low from the opening range. That's the highest high and lowest low for the pre-market, right? Opening range, highest high, lowest low, pre-market, highest high, lowest low, and then our daily, right? Our daily, highest high, lowest low from the prior day, okay? So the daily, right? We interacted with the lowest low, right? On the open of the future session, right? So we've interacted with the lowest low. We've come up, got a bullish breaking market structure right there. So for the pre-market, right, we come down, set relative equal lows, trade up and engage with the highest high, right? We engage with the highest high, trade up, get a bearish breaking market structure, right? Trade back down to the lowest low, right? Remember I said the pre-market and the opening range gave you an opportunity in both directions. So here for the opening, for the pre-market, we set relative equal lows, traded up, engaged with the high, and then got a bearish breaking market structure here, right? Once we got the bearish breaking market structure, traded back up into the range, then drop down, taking out the opposite side liquidity, right? Interact with one side, give you a signature that it wants to reverse. It doesn't want to continue, right? It wants to reverse. So we come here, we go up, right? Consolidate, expand, reverse, retrace, deliver, right there, right? It gives you a signature that it want to reverse. It retraces, then it delivers to the opposite side of the liquidity, right? Coming into the 9:30 time frame, right? This is our lowest low. This is our 9:30 open over here. Right here. Right. That's our 9:30 open right there. Right. That's our 9:30 open right there. Right. So on the 9:30 open here, right? We open there, we set a low, right? We traded up, set a high right there, immediately took out the high, right? We took out the high immediately, gave a reversal signature, right? Came here, bearish breaking market structure, retraced back in, went down to the opposing side right there. Boop, took out the opposing side there. Now, that was the shortened opportunity based off the opening range, dealing range. Now, once we came down and took out the sell side of the pre-market, right? We traded up here, right? Retrace back down there, right? We traded up here, right? Got a break in market structure right there, right? Traded above there, got a break in market structure, right? Now here, you got an opportunity if you trade based off of just order blocks, you got an opportunity there, right? If you trade above this shifting sentiment right here, you got a retracement back into a fair value gap, right? Came down, traded above that high right there. I call it a shifting sentiment because we didn't take out that low right there, right? So I'm not looking at it as a break in market structure, right? Come there, right? Trade it back down into the fair value gap, expand it up, right? Either way you look at it or trade it, that was your opportunity. Taking out the sell side, right? Reversing, going back up to the buy side, right? Traded back up to the buy side with a 9:30 open. Came down below the 9:30 open, traded back up, dropped down to the 9:30 open one more time, right? Traded up, retraced back down, traded up, traced back down, back to the opposite side, right? So it gave you the opportunity going both ways. For the daily time range, for the daily range, we hit it back here. Pre-market came up the breaking market structure. We dropped back down after 9:30, like we said, dropping down below that time-based liquidity from the prior day's session. Once we hit that liquidity, right, traded back up, back to the opposite end of the range, right? Engaged the sell side, gave a break in market structure, delivered to the buy side. So all three dealing ranges that we talked about this morning, all of them delivered in the pre-market in the opening range, delivered to the downside and the upside. Right. While we was live, we watched it to the upside, and then I want to, we watched it to the upside while we was live because the downside happened over here afterwards. Yeah. So we watched it play out to the upside while we was live, but to the downside was later on in the day. And that's your price action recap with a whole lot of very much needed stuff for everybody when it comes to risk tolerance, risk management, and being realistic when it comes to trading. understanding what it takes to actually be able to, take realistic positions and stuff like that, and not just hear a fool say, "Hey, just go risk 1%." Yes, you're right. Don't try to predict the news to try to figure out where the market is going to go. First of all, we don't have a crystal ball. Second, the market is just going to use the news volatility to go to where it wanted to go originally. Exactly. That's why sometimes a certain piece of news will cause the market to go up. Then another time, the same piece of news will cause the market to go down. Exactly. Right? Exactly. The market is going to use that news to get there in a more expedited manner if it's very, very high impact news. Anybody got anything for me? I appreciate everybody that stuck around this long. Hopefully y'all got something out of it. Hopefully y'all found it helpful. Tomorrow is Tuesday, so no tape reading. I'll see y'all at 6 for the price action recap if life don't start lifing. All right. Anything going once? Anything going twice? Anything going 3 times? You're the bum.com. I ain't heard that in a minute. You're the bum.com. You're welcome. Deborah, tell my dog Sure when I said what's happening. Everybody else.
Good with you, man. There you go.
Okay.
What's good with you?
I'm chilling, man. What's up with you? You learned something today? You learned something today, Sherwin?
I learn something every day.
Oh, man, I appreciate you, man. You make me feel like I know what I'm talking about.
Yeah, you know a little something.
A little something, man. You know a little something. I'm trying to get on my cousin level. Hey, man.
Which one?
I knew you were gonna say something. I'm trying to get on my cousin level, man. Hey, you're welcome, Kashaya. Karen Kashaya said thank you. Yeah, like I said, man, these real conversations that we need. That's why, looking at candles every day, that's fine. But I be wanting the hard-hitting questions because it be stuff out there that somebody have in their mind and they don't know how to formulate the question, or they may be afraid because they think they're going to sound silly. Don't nobody sound silly. You know what I'm saying? Hey, I act a fool to make y'all feel real comfortable. Ain't nothing serious around here. Play, joke, ha, 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 key. I want y'all to feel comfortable enough to ask what you feel to be it's the such thing as a stupid question. Now, I do believe that, but I want you to be comfortable enough to ask those stupid questions because you might be helping the person right next to you. You don't know how, Karen, you don't know how many people you just helped just now. You just helped so many people. You know what I'm saying? You just helped so many people just now based off this conversation we just had. Because there's so many people out there that's not giving you the hard, stone cold facts when it comes to how much money you're going to need to trade. You know what I'm saying? Ain't nobody willing to tell you, oh, I can't answer this for you, but if this is your number, this is a way you can approach it. I can't answer this for you. Here's a way you can approach it. Here's 2 ways you can approach it. But this is what it's going to take to trade. This is what you can realistically expect. Just like when I said, it just happened. You just got margin call. Karen said, oh my goodness. You know why? Because she didn't know that. She didn't. And I'm pretty sure a lot of people didn't know that. I'm pretty sure a lot of people don't know if your equity falls up under the minimum that's required to hold that position, that the broker will just close that that trade. If it drops below, it's going to close it. It's called a margin call. Back in the day, they used to get on the phone and be like, hey, Tony, hey, you got to give him that money. You remember at the end of that show, that movie Trading Places, when they called the Dukes? When they had called the Dukes and was like, we don't have that much money to do that. That's they margin called them. There was margin calling them. Hey, you got to pay up right now. You got to pay up right now, or you need to start liquidating some assets to give me my money.
I saw that movie the other day. Hey, what he said when his brother had a heart attack.
But I can't. But he was like he was hitting on him. He was like, what did he say?
It was the Dukes. Did you say that?
That's when he was choking. He was choking Eddie Murphy, but he was hitting. He was like hitting on him, and he was because he was telling him to get out there and sell.
But it said F him. He was like your brother.
yeah. F him. Get out there and sell. Get out there and sell. That must And then in Coming to America, it said, Randolph, I'm still not talking to you, Mortimer.
Or say, we're back.
We're back. Randolph, we're back. Oh, man, I'm about to go find Trading Places and look at it, man. I was got crazy in the dog in the hubcap factory. Man, anyway, I appreciate y'all for hanging out with me, man. Yeah, man. I'll see y'all tomorrow at 6 if life don't start life, man. Y'all enjoy the rest of y'all night. Take some time, hang out with your loved ones. Y'all pray for my my girls and their mama. My girl's grandma just passed away yesterday. So pray for my girls and their mama and their aunties and their uncle, their whole family. Pray for them. Miss Trisha. Pray for the Thomas family. Her name was Trisha Thomas. Pray for the Thomas family. I'm still waiting on them to give me the details on what they're gonna be doing as far as the service. But spend time with your family, man. You never know. Something like in her case, it was expected, but a lot of times it's not expected. You know what I'm saying? And death come knocking at your door. It don't be expected sometimes. Like I say, in their case, it was expected. It's still hard, but it's expected. Sometimes it's a little bit harder when it is expected because you watch your loved one wither away. You know what I'm saying? But take some time to spend some time with your family, man. Don't mean to end it on a somber note, but life is real. You feel me? I'll see y'all tomorrow. If life don't start life, and y'all take it easy, man. Till the next time I decide to get on Algo's internet and share my thoughts on this thing that we call price action. It's your boy, Timothy Lee Rogers Sr., a.k.a. Aranya Grande.